We have entered the Q1 2024 earnings season, and we got some notable reports this week, all out of the technology and communication services sector, and three of the largest companies in the US, which are Alphabet, Meta Platforms, and Microsoft. In today's video, we're going to break down those earnings reports. We're going to look at updated valuations to determine whether the stocks are a buy, sell, or hold. So make sure you stay tuned throughout the entirety of today's video. And before we begin, do me a huge favor. Click that like button down below. Subscribe to the channel as it's really helpful and I really appreciate it. And let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now you can go to fool.com/Mark to sign up to receive their 10 best stocks to buy right now. All right, let's jump back into these three key earnings reports, beginning with Meta Platforms, stock ticker META. Meta Platforms dropped a bomb this week. The company reported $4.71 in terms of EPS compared to analyst expectations of $4.32, so they beat on that metric. Revenues came in at $36.46 billion, increasing about 27% year over year, and those beat expectations by $240 million. So the company beat on both the top and bottom lines, but these days it's a lot less about what you did for investors, and it's a lot more about what are you going to do for investors. And that's the key part that hurt Meta after reporting its latest earnings. As you can see on the screen, Meta shares fell more than 10%, and at one point, they were down more than 15% after earnings. The company currently has a market cap of about $1.1 trillion after its move. Even with the drop, shares are still up more than 110% over the past year. In terms of other metrics during the quarter, the company had 3.24 billion daily active family users there, an increase of 7%. Ad impressions increased 20%, and the average price per ad increased 6%. So what happened? Why did shares fall? Well, the company made some commentary about lowering their revenue forecast moving forward and increasing their capital expenditures, the amount of money that they are going to spend to reinvest. Lower revenue, more spending. Not a great combination to tell investors. In the past, Meta Platforms has had some major spending problems, especially when it comes around to artificial intelligence. However, in year 2023, they made it the year of efficiency. They trimmed and lowered the amount of spending they were doing to get more lean as a company. However, this year, it looks like maybe they're reverting back to their old ways. But CEO Mark Zuckerberg alluded to on the call and in the press release that the company has to invest in the next phase of growth. After all, the company earns 98% of their revenues from digital advertising, and AI is expected to play a huge role in that moving forward. Capital expenditures for 2024 are anticipated to be between $35 and $40 billion. That was an increase from the prior forecast the company gave between $30 and $37 billion. So what do you do as an investor? Well, first you got to understand, what are they spending it on? And do you trust the way management is spending those dollars? Have they earned your trust in the past with the money that they spend has resulted in exponential growth? Yes, you could say that about a lot of things. One of the most prominent things that they spent on for a number of years was Instagram Reels. That is now being monetized. Facebook Messenger, that is now being monetized, and a list of other things. The next thing you got to do is look at valuation, where analysts are expecting the company to generate 2024 EPS of $20 per share. EPS growth over the next 3 years is expected to average around 22% per year. That gives the company a forward PE multiple of 22.0 times. That compared to their 5-year average of 25.1 times looks quite favorable. And when you look at the PEG ratio, which takes the PE ratio and also brings into account the growth that the company will have over the next 3 years, the PEG ratio sits at 1, and I'm usually looking for a PEG ratio of 1 or less. I'll stretch it out to 1.25, so the PEG ratio looks quite intriguing right here. The PE that you're paying compared to the growth you're getting does look solid. So the valuation looks pretty solid overall, just looking at those two quick metrics. So you really got to ask yourself, and there's a lot of concern with investors that have been along this path with Meta. They finally saw the company trim back on its spending. It's not like it trimmed back and wasn't spending anything. It was still spending billions of dollars. But now there's those concerns about, are we turning back to old ways? Well, let's take a look at what analysts think about the stock moving forward. They rate the stock a strong buy with a 12-month average price target of $547, implying 24% upside from current levels. So analysts are on board with the stock. They think buy this dip. And I think right now, I usually have about a 3-day window when we see big moves in a stock like we have in Meta. But I think we've seen kind of a track record with other companies, not only Meta itself, but with other companies, whether it's Meta or Alphabet that we're looking at here in a second. They've had to increase spending, especially around AI as well, and they're starting to see the benefits pay off. So it's really nothing new here, and I like to think that this is a buy the dip opportunity. And that leads us to stock number 2 that we're going to look at, which is Microsoft Corporation, stock ticker MSFT. This is a massive company, the largest company in terms of market cap here in the US, and they've been performing quite well over the past 12 months, so the bar was set pretty high heading into this earnings print. The company currently has a market cap of nearly $3 trillion, and over the past 12 months, the stock is up 45%. Year to date, it's up 6%. In terms of earnings, the company beat on both the top and bottom lines. EPS came in at $2.94 per share compared to analysts' expectations of $2.82. Revenues came in at $61.86 billion. Analysts were looking for $60.8 billion. So a nice little beat there on both the top and bottom lines. Revenues grew by 17% year over year. Here's a look at some of the key areas of the business and what the growth has looked like each quarter. Azure, the top line, is the most closely watched by investors, and rightfully so. After 4 consecutive quarters between 2022 and 2023, they saw slowing growth. But we have seen a rebound in Azure, which has increased growth now each of the last 3 quarters, growing 31% year over year in the latest quarter. Overall, a fantastic quarter. The bar was set high going into the print, and the company easily met those expectations. CFO Amy Wood made some comments around moving forward with AI and capital expenditures, which I thought were quite interesting. As you can see here, she noted that currently near term, AI demand is a bit higher than our available capacity. They have more demand than they can handle. So what has the company been doing? Well, they've been increasing its capital expenditures. Well, that sounds like they're spending more, similar to what we just heard with Meta Platforms. They're looking to secure NVIDIA graphics processing units for training and running AI models. The company came out in their report last quarter talking about an increase in capital expenditures. So this didn't really come as a surprise, but the stock got hit in the last quarter. Again, a very similar route to what we're seeing with Meta Platforms. The other takeaway that I saw during the quarter was the rebound in PC, personal computers, hardware, which has been having a brutal run for a while, but a lot of analysts were expecting a rebound in that area, which is not only good for the PC makers, but also for the chip makers as well. So now we've had a look at the latest numbers. Let's take a look at valuation. This is a company that's been trading at an extreme valuation, a very high valuation, a premium, I should say, but rightfully so. They've been generating solid results and they're safe and consistent. After all, they have a AAA credit rating. Only a few companies can claim fame to that. That's a higher credit rating, a higher safety rating than the US government. So looking at this, you need to take into account that shares are up 4% after hours at the time of this video, so we'll use that price when determining valuation. Analysts are expecting next 12 months EPS of $13.29 per share, and EPS growth over the next 3 years on an average basis is 16% per year. That gives the company a forward PE multiple of 31.4 times, compared to their 5-year average of 32.3 times, and giving them a PEG ratio of 1.9 times. So shares look fairly valued at these levels, but the lower growth yet higher PE is hard to look to add to these levels. A lot of growth moving forward for the company, but a lot of that seems to be priced in. There's still a decent amount of growth moving forward with the company, a lot to like about this company. However, valuation doesn't look all that intriguing at these levels. You can like a company, but see a disconnect in terms of valuation. That's what makes a market a market. Let's take a look at what analysts think. They currently have the company a 12-month average price target of $477. So they're still high on the stock, implying nearly 20% upside from current levels. So when it comes to buying Microsoft, I currently own shares of Microsoft. It's a top holding for me, not as high as the next stock on our list, but still a top 5 holding overall within my portfolio. So given not much looks cheap in terms of this stock, I rate Microsoft a hold. I'm definitely not trimming my position, but I'm definitely not running to buy any shares, especially with them up about 5% after hours. And that leads us to stock number 3 on our list, which is Alphabet. Stock ticker GOOGL. And if any of you are out there Edge Plus members, which is my Stock Investors Edge newsletter premium subscribers, if you follow along in my portfolio, then you know that Alphabet is my largest individual stock holding within my portfolio. And before we get into the results of that, let me take a second to tell you about the Stock Investors Edge, where you can become a premium subscriber, an Edge Plus member, where we currently have a 7-day free trial. You can try it out completely free. What will you get with that? You'll get access to my entire portfolio. You'll actually get access to multiple portfolios. We do a stock deep dive each and every week. We do earnings recaps over all of the stocks that we cover. In addition, you'll get a top watch list stocks and much more. So definitely check out the link down in the description below to become an Edge Plus member. We recently just rolled out our Discord channel, our community where you can get quick access to both me and my team at a moment's notice. So now let's get back to the Alphabet results, which if you can't hear it in my voice, I am stoked. I am super excited because again, this is my largest individual holding, and this company knocked it out of the park. The company absolutely crushed it. EPS came in at $1.89 compared to just $1.51 expectations. Revenues came in at $80.54 billion. Analysts were looking for $78.6 billion. Alphabet easily beat expectations, making this a dynamic report here. And if you've watched any of my previous videos or watched me and joined during our Dividend Power Hour where we've actually talked about Alphabet, how it's been one of the cheapest in terms of the Mag 7 stocks that are out there. I've been a big fan of it and been adding to it regularly. The other thing I've noted on a regular basis is to not count this company out yet in terms of AI. Remember, Microsoft bought their way into AI by investing in OpenAI. Google has been building it themselves so that they can roll it out into the likes of YouTube as well as Google Search, which happen to be the 2 largest search engines in the world. With the stock up 12% after hours, these figures are primed to move higher. The market cap currently sits at $1.96 trillion, but that after-hour moves will take them above the $2 trillion mark. Over the past 12 months, the stock is up 50%, but again, that's going to move higher as well. Year to date, the stock is up 12%, and the after-hour move will put them closer to 25% year to date if those after-hour moves hold. Oh, and I'm also happy to announce that Alphabet is now a dividend stock, following in the footsteps of Meta Platforms, who the previous quarter, one before this one, announced their very own dividends. So now Meta and Alphabet are both dividend stocks. Not huge in terms of yield, less than 1%, but tons of room for further growth there. Oh, and if that wasn't enough, if that doesn't give investors confidence about the free cash flow moving forward, how about the announcement of a $70 billion stock repurchase program that they just announced during this earnings report as well? So all of this that I've been talking about for a number of weeks and even months now is all coming to fruition. Things don't just happen overnight. You got to take the opportunities when they're given to you as an investor. Let's take a look at some of the other stats. So revenues overall jumped 15%. Advertising revenue jumped 13%. YouTube ads revenue jumped 21%. Subscriptions, platforms, and devices saw revenue climb 18%. And let's get into some of these details here that I love. Operating income, a key metric that I track, jumped 46%. The company growing revenues and getting more efficient. Operating margin expanded 32%. That's where you can see how efficient management is becoming. A year ago, operating margins were sitting at 25%. Today, at 32%. There's literally nothing bad in this report. And if you can't tell, I'm a pretty happy shareholder. So what does valuation look like? Analysts right now are expecting 2024 EPS of $6.82 per share. EPS growth over the next 3 years is expected to average around 20% per year, giving the company a forward PE multiple of 25.5 times. That compares pretty much in line with the company's 5-year average of 25.3 times. And the PEG ratio currently sits at 1.27. So looking at the PE, shares look fairly valued now with the after hours move. But that makes sense since we're talking about a double-digit move higher. The PEG ratio, though, still is on the verge of looking pretty solid there. So again, I love the company, but it's also my largest position, so not anything I'm looking to run and back the truck up to add at these levels. let's take a look at what analysts believe, where they're not as high on the stock as they have a 12-month price target, which is actually below the after-hours price, indicating really no upside, but I expect those to be reevaluated in the coming days since that report just came out. So when it comes to my rating, I'm going to also rate shares of Google, or Alphabet, I should say, as a hold. So we got Microsoft as a hold, we got Alphabet as a hold, and I'm going to go out on a limb and rate Meta Platforms as a buy. I can see that this area right here at 22 times as a place that you can start nibbling. I usually have my 3-day rule, so I'm probably going to wait myself, but at that valuation, seeing the different path that other companies have taken, like Microsoft, like Alphabet, I don't have a big issue with it right here. And I see this as an opportunity for a long-term investor, which I am. So down in the comments section below, let me know which of these 3 companies, if you had to buy one of them right now, would it be Meta, Microsoft, or Alphabet? And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.